Hello, investors and traders. This video is about fear and euphoria in the stock market. I will explain the VIX and the VXN and how to use this technical indicator in your trading or investing strategy. I will go in depth on how to use this indicator and how to predict the overall market. This indicator will give you a clear picture of what is happening in the stock market. As usual, one indicator does not make a strategy and should be coupled with other indicators and philosophy. So you know the catchphrase: study it, analyze it, adapt it. If this video brings value, please subscribe to the channel. Unleashing the power of the VIX and the VXN, tools for successful trading. The VIX and the VXN is usually called the fear index. In general, the CBOE Volatility Index, or VIX, is a measure of the expected volatility of the S&P 500 index over the next 30 days. It is often referred to as the fear index because it tends to rise when there's a market turbulence or uncertainty. The VIX is a volatility index created by the Nasdaq Stock Exchange. It measures the expected volatility of the Nasdaq 100, which is the stock market index made up of the 100 largest non-financial companies listed on the Nasdaq. The VIX and the VXN will help you predict the overall market. VIX, VXN. The VIX can be used by traders and investors as an indicator of market sentiment. When the VIX is low, it suggests the market is calm and stable. There is not a lot of fear or uncertainty. However, this can quickly change, and when it does, the VIX will rise. This could indicate that traders and investors are becoming more fearful and uncertain about the future direction of the market. Traders and investors can use the VIX to make trading decisions. When the VIX gets low and lower and lower and at extreme levels, there is no fear in the market, and any news can set the VIX to go up higher. My first look is at extreme levels. Is the VIX at extreme levels the last year, the last 2 years, the last 3 years? This is the first home run that you can have when the VIX or the VXN is at extreme levels. You could also see the VIX and the VXN in certain trading patterns throughout the year, and specifically yearly. Sometimes in the years, the VIX can trade at 15 to 18 and then quickly go up, and vice versa. The VIX can trade at 30 or 35 and then go down. It is important to note that the VIX is not a perfect indicator of the market sentiment. It can be influenced by various factors, including geopolitical events and economic data releases and the company earnings reports. Traders and investors should use the VIX in conjunction with other market indicators and their own analysis to make informed trading decisions. The VIX is volatility index, combining indicators with the VIX and the VXN. When using the VIX as an indicator of market sentiment, there are several other indicators that traders and investors can combine with it to make informed trading decisions. Technical analysis. Technical analysis involves analysis, historical price and volume data to identify trends and patterns in the market. Traders can use technical analysis to identify support and resistance level, which can help them make buy and sell decisions. By combining technical analysis with the VIX, traders can get a more complete picture of market sentiment and identify potential trading opportunities. Moving averages. Moving averages are used to smooth out price data by averaging price over a certain period of time. Traders can use the moving average to identify trends in the market and confirm buy and sell signals. By combining moving averages with the VIX, traders can identify potential entry and exit points based on changes in market sentiment. Economic indicators. Economic indicators such as GDP, inflation, and unemployment can have a significant impact on the stock market. Traders can use economic indicators to get a sense of overall health of the economy and to identify potential trends in the market. By combining economic indicators with the VIX, traders can get a more complete picture of market sentiment and more informed trading decisions. Number 4, market breadth. Indicators. Market breadth indicators such as advanced decline line measure the number of stocks that are advancing versus those that are declining. Traders can use the breadth indicator to identify potential trends in the market and to confirm buy and sell signals. By combining market breadth indicators with the VIX, traders can identify potential entry and exit points based on changes in market sentiment. Options. Options market data. Since the VIX is based on the option price, traders can also use options market data to supplement their analysis. For example, they can look at put and call ratio, which measures the number of put options versus all options traded. A high put call ratio could indicate that traders are becoming more bearish, which could lead to increased volatility. By combining options market data with the VIX, traders can get a more complete picture of what market sentiment and identify potential trading opportunities. In conclusion, there are several indicators that the traders and investors can combine with the VIX to make more informed trading decisions. By using a combination of these indicators, traders can get a more complete picture of market sentiment and identify potential trading opportunities based on changes in the volatility and market trends. Using the VIX as one indicator can give you good results, but combining it with other indicators, for example, moving averages, economic indicators, or market breadth, can give you a weight of evidence to give you a higher probability of success. One indicator does not make a system. There are nearly 24 volatility exchange traded products, ETPs, for the VIX. How can I trade the VIX? The VIX can be traded through future contracts and exchange traded funds, ETFs, and exchange traded notes. How can I trade the VIX? The VIX can be traded through future contracts and exchange traded funds, ETFs, and exchange traded notes, ETNs, that offer these future contracts. You can purchase the VIX like a stock or bond. Instead, you can purchase instruments that respond to fluctuations of VIX. Traders can place their hedges through VIX options and futures. There are nearly 24 volatility exchange products, ETPs, for the VIX. This includes both exchange-traded funds that hold the assets and exchange-traded notes. Contango and decay. A common misunderstanding of the VIX and ETFs lead to a rude awakening when investors would experience the ETFs falling even when the S&P sold off over time. This is due to price gaps that erode the valuations to tracking its assets every morning. Underlying VIX futures can experience contango even when the VIX is flat. Contango occurs when futures trade at a premium to spot prices ahead of expiration. Exchange-traded products can be rolled over like futures. Instead, they undergo rebalancing that cause symbiotic triggers, purchase at higher prices while selling at decayed lower prices. This, along with slippage from gaps, can result in monthly erosion ranging from 8 to 13% on an average per month. Timing of getting into the VIX. Even with the ETFs, there is erosion of price every day that you hold on to this vehicle. Even if you trade futures, you're still looking at time decay. So the first time for novice investors getting into it, even though the S&P was flat or the VIX was flat, they were still losing money. So the timing of the VIX and the VXN in any instrument needs to be very careful. How the VIX is used. The VIX can help investors gauge the market sentiment as well as volatility to identify investment opportunities. As volatility can often signal negative stock market prices, volatility instruments can be used to speculate and hedge in risk. The numbers that I'm giving you now are basics. Yearly should be more looked upon, but just look at this. 0 to 15. This can indicate a certain amount of optimism in the market as well as very low volatility. This number can stay 0 to 15 for a long time. Well, not 0, but close to 12, 11, 9. It can stay for long periods of time. 15 to 25. This can indicate that there is a certain amount of volatility, but nothing extreme. Many years, I have seen the VIX trade between 15, 17, and 18, and then quickly jump up, and that was the price point. 25 to 30. This can indicate there is a certain amount of market turbulence and volatility is increasing. 30 and over. This can indicate the market is highly volatile, and there may be some extreme swings soon. Watch the extreme levels. This is the main key. If you just trade off the extreme levels of the VIX and the VXN, the probability of success will be very high for you. There's also a correlation, as we said, between the VIX and the put-call ratio. Fear barometer. As the primary fear barometer, the VIX index chart is particularly useful in the timing as dictated by the fiscal year. Generally, a high VIX reading denotes heightened fear among investors, while a low reading denotes general complacency. As stated earlier, the VIX tracks implied volatility based on options market. The overall market stock market is long bias, which means the VIX generally displays sideways to gradual movement. It is the VIX sustained low levels that warn keen investors of potential compliance in the market. Interestingly, market declines usually trigger an overreaction by market participants who seek to cover their positions by buying put options. This is what drives the VIX, confirming over fear among investors. In this spike, the VIX can help traders use temporary or definitive market bottoms in anticipation of longer-term higher price movement. This is especially ideal in a general bullish market where there is to pick an optimal price entry points. The reverse is true, which is sustained lower VIX readings, which denote compliancy and can help investors pick out the market tops. Some common questions. How the VIX is used. The VIX can help investors gauge market sentiment as well as volatility to identify opportunities. VIX seasonal patterns. As primary fear factor, the VIX index is particularly using in timing as dictated by the fiscal year. Generally, a high VIX reading denotes heightened fear among investors, while a low reading denotes general complacency. Let's continue. Should I trade the VIX index? If you are looking to make profits when the markets are in wide mood, you need to look no further than the VIX, because this indicator tracks volatility. It can be a good way to profit from volatility markets when there's no certainty which any individual stock or other assets might go on a daily basis. Anytime you see fear and uncertainty rising in the markets, perception is good time to buy the VIX, since fear and uncertainty typically lead to increased volatility. Conversely, when investors are feeling confident, volatility will decrease, giving traders the chance to profit by shorting the VIX. How does the VIX index impact the stock market? The VIX and the S&P are considered to be strongly negatively correlated. That means the VIX is increasing, the S&P is likely falling, and when the VIX is declining, stocks are likely rising. Remember, the volatility doesn't measure the direction of the price movement, rather it measures the rate or change or how rapidly price moves up or down. Many traders believe the VIX can predict tops and bottoms in the S&P 500. As the VIX reaches extreme high levels, it's seen as a buy signal for the S&P 500, but when it reaches extreme low levels, it is esteemed a sell signal for the S&P 500. What is the best way to trade the VIX index? Rather than the VIX is directly, it is possible to use VIX to trade the equities and indexes. That is because when volatility is rising, stocks and indexes are generally falling. But when the VIX is falling, indexes are generally rising. At the very least, the VIX can be used as an initial signal to begin looking for signs to buy or sell in the market based on the direction in volatility. The VIX can also be used to confirm fundamental data that indicates increased uncertainty of fear in the market. If the VIX is not rising in response news that can cause uncertainty or fear, then the market is either ignoring or discounting the news. As usual, one indicator does not make a strategy and should be coupled with other indicators and philosophies. Weight of evidence. In all our strategies, in all my philosophies, one indicator does not make a system. We can combine the VIX with the RSI, with the moving averages, with advanced decline lines, with call and puts. We're putting it all together, these indexes. Every morning, I look at the VIX and the VXN. Every week, when I am planning my strategies out for the week, there is one page all about the VIX and the VXN. Let me tell you a story. Bob thinks the market is going down, so he buys options. The market is going down. If enough people join Bob, the option to cause option prices to go higher. Lots of people are nervous will send the VIX higher. VIX is low if people think the market is going higher. No fear and euphoria in the market. Usually the masses are wrong. The more fear or the higher the VIX, the more opportunity is to buy. Also, the lower the VIX, the less the opportunity to buy and the more place to take profits. Initial breakouts or breakdowns are the best place to get involved, as usually the first move leads to violent upswings or downswings. As you know, from real-world examples, let me go over the year 2022. It was going through a trading range of 19, and every time it went below 19, it zooms back upwards to anywhere from 25 to 30 to even 35. In the year 2023, it has changed and has been hovering around the 1819. So for real world examples, every 6 months, every 3 months, even the VIX changes, or even year to year. So in 2023, we use the VIX a lot differently than we use it in 2022. Let's continue. Again, usually the masses are wrong. That's why the VIX is very good indicator. Usually the first moves leads to violent upswings or downswings. This is the VIX. Study it, analyze it, adapt it. Peace.